Hello, money and banking students. This is our final week, so I want to say that I've enjoyed working with you all over this 8-week time period. So just make sure to wrap up everything for week 7, and then final week 8, you'll pretty much have your quiz, your homework, your forum discussion, and then the final exam. So try to get it wrapped up early and enjoy the final weekend. So for this week, we have our last 3 chapters of the textbook. Look at reading chapters 22, 23, and 24. Chapter 22 kind of looks at on-balance sheet asset management. Oftentimes, we may have different intervals, or what we might call like buckets, if you will, of when our assets and liabilities fall into maybe like a day maturity, year or less, 1 to 2 years, 2 to 5 years, etc. So it points out in the textbook, you may have such certain situations where maybe the assets are greater than the liabilities, or the liabilities are greater than the assets, so there are gaps. And they're not matched. So what can happen is, like if there is an increase in interest rates, and let's just give the example like the textbook of a one-day like use of Fed funds. If I have $30 million in liabilities that I have to pay because I'm borrowing on that, it goes up 1%. And I'm receiving so much on my asset side, well, there could be a gap that exists that actually results in an interest rate loss. So managers try to reduce this risk. And in this chapter, it kind of focuses on how they can either identify those gaps and they can rebalance their portfolios. But the following chapter talks about different ways that through derivatives they can use that. But the 2 main models that they talk about in this chapter are the repricing model and the duration model. And they point out the duration model can be a better model because it focuses more on the market values. And although it is a linear relationship, as you'll read it in the textbook, there may be some differences versus actual versus the pricing, but it will come pretty close. And in chapter 23, they look at more of the derivative sides. And we've talked about these things before in previous chapters, but it just gets into more detail how a bank manager can use it to try to protect a portfolio. There are a lot of different options that they can use for derivatives. Essentially, a financial institution is using it to hedge. If you are not have an underlying security that you're concerned about, it's purely speculative, and that's somewhat gambling. But as long as there's something that you're concerned about, we can hedge. And they mention like a forward contract where it's between 2 parties at a specific date. It's agreed on maybe 3 months from now that something will be delivered at a specific price. So it locks that in for you, so you don't have to worry about uncertainty about interest rates, how they might change, what the price of something might be later. Another could be a futures contract. The textbook uses a lot of examples with bonds and the inverse relationship with bonds. As we said before, as interest rates rise, the present value of bonds are going to drop. As interest rates drop, the present value goes up. So the financial institution can be exposed to those risks. So what they might do is, if they're worried about something moving in a particular direction, they can take out a futures contract. And a futures contract is done by an exchange, so it's based on mark to market, and money is added or subtracted to that account. So as an example, if I'm worried about, say, the particular value of a bond dropping in price, I can take out a futures contract that will protect me if the bond price does fall. Okay. So, and essentially also too with futures contracts, they use the term going long or going short. So if you're going long, you're kind of pushing that the price goes up. That's kind of the betting the direction you're taking on. If you're going short, you're betting that it's going down. So if it was the case in the bonds, if the prices did drop, you're going short, money would be added to your account, although on your asset side of the balance sheet, the bonds are now worth less. So you're trying to protect yourself. They also mention with the use of options, they can be popular too. They talk from both the financial institution side, being either one that buys the option or writes the option. So the person writing an option, they're looking, it's almost like an insurance company. You think that they write it, the hopes that it is not exercised, but they are exposed to risk if someone does want to exercise that option if it's in their favor. And a call option is the right to buy something at a specific price in the future, and a put option is the right to sell. So I'll use the put option, for example, a financial institution. If you have bonds in your portfolio and that you're worried that they're going to drop in value, you could purchase a put option, the right to sell, and that way you'd be protected if that bond price does drop in value. Of course, the writer is going to write it in such a way that there's going to be some premium, and once it hits that exercise price, it becomes a value. Other things they mentioned too is they also looked at swaps. It's a little bit more complex to understand, but I can read through this area slowly. But somebody may have something that's a fixed, and somebody may have a variable, and they're kind of swapping them out, exchanging payments to reduce the risk. Okay. But last thing in the chapter 24, they talk about loan sales and securitization. Think of this essentially as a way that FIs can take certain things off their balance sheet to a degree, and it frees up cash flow to allow them to reissue more loans. So it's kind of a loan sales is you're kind of selling ownership, maybe breaking it apart, but securitization, whether it's your credit card, your mortgages, they're packaged together and resold to large institutional investors. I did talk a little about the subprime crisis, and this ties into other chapters too about some of the credit default swaps in chapter 23. But it can result in potential losses if there's not regulation in place, and that's always an ongoing concern to make sure to understand how these investments work, because in the subprime crisis, it resulted in a lot of toxic debt on people's balance sheets that didn't have much value, and it pretty much caused the financial crisis. So, all right, that's a summary of things that you're going to be reading about this week. So, again, make sure to jump early for the forum discussion. This is our final week. So, again, I want to say I've enjoyed working with all you this past 2 months, and enjoy the rest of your summer, and we'll talk to you online. Take care.